Today, traders, we're going to be discussing other time frame traders and the 12 candle window. Stay tuned. We'll be right back. G'day traders, Stacey Burke from Stacey Burke Trading. Last day we had a video discussing the 4-hour or other time frame traders being in the market, and I explained in that video that I had color coded those boxes strictly on the 4-hour time frames so that traders could see where one 4-hour box ended and another began, in the hopes that people could understand that 1 hour, 4-hour daily high-low levels can be triggering other time frame traders into the market. That was not replacing the high probability time frames of the 12 candle window, which, again, coming back to our 3-hour Asian window, 8 to 11 p.m., 2 to 5 a.m. for London, and 8 to 11 a.m. for New York, all times New York Eastern Standard Time, is our high probability targeting time frame for when the middle hour of those 3-hour windows is the equity market opens. Obviously, Asia being the exception, it has a slightly different behavior. We're going to look at some very specific, important key aspects to understand in how I approach the market, how other traders can be getting trapped or triggered into the market. And they may be in the right direction, but we may also be in a market that may go 25, 50 pips against them prior to moving in the direction of that underlying move. And so it's important that, coming back to the premise that nobody gets a free lunch, if you're trading a breakout system, you're very familiar with a lot of breakouts will fail initially in terms of maybe not necessarily going 50, 75, 100 pips in your direction right off the bat. They initially may have a burst of 15, 25 pips, but then you check a few hours later and you're underwater by maybe 15, 25. And if it's gold, it could be 50 to 75 pips. So important to compare the understanding of other time frame traders entering in on breakouts of highs and lows at monthly, weekly, daily, 4-hour, and hourly levels. When I'm targeting this 12 candle window in Asia, specifically for gold, I'm looking at that movement to be going 25 to 50 pips. Asia will establish a high-low range of approximately 75 pips from high to low every single day, which gives us our benchmark high and low where the rest of the session will start to trade from. But that initial range typically will have to do with triggering other time frame traders into the market. We'll be talking more in the coming videos about creeping trends and consolidated volume, which are low-hanging fruit for stop hunts. And again, understanding going into each session, having a premise of how the market will set up the type of price action that you will look for, and knowing that, especially in Asia for gold, typically that move will be 75 pips from high to low. So you may be in the middle of a move that's already going, and at that point we may be triggering other time frame traders into the market in that lower level or higher level on the last leg of the move, especially in that middle hour. So just comparing the two and understanding the importance of knowing about other time frame traders being in the market, especially at daily highs and lows. This is where traders can get trapped on breakouts. They have their stop loss order typically placed on the opposite side of that time frame entry candle. So again, our high probability strike time is, if we come to these times and the market is already moving, you have to ask yourself the question, are they taking me further into the extreme with the trend at that stage, where I'll be getting caught up high for a stop hunt below my position, putting me underwater, stopping me out, or, even if I'm in profit, am I getting caught at the end of the move, all those sorts of things. Or if we've gone sideways into consolidation and I want to go long, am I expecting a stop hunt high, triggering traders first mouse, then hitting stops on the downside before the move continues, that sort of scenario. So that we're going to have an extended consolidation and we're going to have a sideways consolidation. But important to understand what time frame traders can be getting triggered prior to a trade coming in our high probability strike zone times. So again, for trend trades, reversal trades, and trading range stop hunts. So the first or last hour of a 4-hour cycle can typically be a stop hunt to the higher low of the daily session. So again, understanding that last hour of a 4-hour cycle, we may see a move back to the high or back down to the low. And again, understanding how large is that range? Are we down low? Has the market already moved? Depending on which instrument that you're trading. For gold, for example, it may be 25, 25, 25 in Asia. And then they pull it back and they're working it down again towards that end of the 4-hour window, or have they already locked in that low and they're moving back towards the top? But as Europe and London are opening, we may be mid-move already or into that last 25 pip range. If it's the euro or the pound, we may be sideways in a 25 pip box. We may have stops 25 above or below. And again, we're going to get more into the Monday, Tuesday opening range for the week. Very important to understand the levels, whether or not weekly levels have been broken as the beginning of the week starts to trade. Double zeros and 50s can have a major impact depending on, again, the instrument that you're trading. The pound, gold loves double zeros. The question you need to ask yourself is, where is the trap volume? Who is trapped? Is it shorts or longs? Where are their stops? And then going from there. So again, not confusing the 4-hour boxes that I had last video with our high probability strike zones. For simplicity's sake, I've just put our normal time frames on again, our 3-hour 12 candle window. And if you are trading gold, you'll know that gold has an hour gap when the rollover happens, but I specifically still use the same 4-hour time frames that apply to all the other currency pairs. So coming back to what we talked about earlier, that would be on the chart. The chart time is 4 o'clock, 8 o'clock, 12 o'clock, 1600, 2000 hours, and then 0 again. In terms of New York time, we're talking about 9:15, 9 o'clock, 1 o'clock, 5 o'clock, and that goes around the clock, AM and PM. So 9:15, 9:15. Those are the rollover times for the 4-hour charts. New York closing chart time. Now, I know traders are telling me they're using Europe closing time, whatever. New York, the cycle starts on New York time. The 24-hour market starts and ends on the New York time. All times for me are based on New York. I don't care what other people do. That's the time. The most important time is the New York time. So when we have our 3-hour window printing, typically that will establish the high and low for the session. If they extend outside of that high and low, again, coming back to some simple concepts in Asia, for example, for gold, we will normally have 3 levels of rise or fall. We have 1, 2, and into the 3rd level, we have the false break, pullback, reversal. So coming back to understanding that each session, so especially for Asia, and we'll look at the euro and the pound in a second, each session, depending on where we're at in the days of the week, if we go back to Monday, and again, we're going to get more into this in coming videos, the initial balance, Monday's high and low, to me establishes the trading range, our trading range for the week. And then we want to be asking ourselves, have any weekly levels been broken? So we can have a previous day's high or low broken, but we want to know, have we broken any weekly highs or lows? And in the case of gold, we don't see a weekly level get broken until the Tuesday last week, where they broke the high of Monday. That is the high of the current week. We've broken the previous day's low. They've pulled it back inside. They've come up and triggered the previous day's high. So again, understanding that we have a box, and this trigger on the previous day's low, previous day's high, triggers other time frame traders into the market. This initial burst out triggers a break of a 4-hour low. We have 4-hour, 1-hour traders now in the market. And then when it breaks the previous day's low, we have end of day traders in the market. When that market has been triggered, understand that if you were trading the breakout of that time frame, the market engulfs at the low in our 12 candle window, whether that's US, London, or Asia. And now we have a stop hunt back inside of the range. But again, coming back to understanding the simple concepts of traders getting trapped. In order for somebody to make money, somebody has to lose money. So the important part to grasp from today's video is that there's no confusion between the 12 candle window and other time frame traders. It's important for you. It's like a water wheel in an old mill rolling through the river. It's constantly evolving and turning. It never stops. And this market is always moving. We had 3 pushes into the peak formation, stop hunt down low, triggering other time frame traders, engulfment, and a 50 pip stop hunt back up into the short trade. So once other time frame traders are triggered into the market and it's in our high probability time frame for trade entries, the most important part to understand is, have they triggered other time frame traders and are they trapped? And do I now have price behaving, confirming an entry for a move either with the trend, back into the trend, or back into the range, whatever that may be? And again, typically as Monday, Tuesday evolve, we now have 3 pushes into a peak formation at the high of the week, a pin hammer at the high, and we have a stop hunt back down to the low of the week. And we're going to get more into this in the coming videos. My ideal setups evolve over the course of the week when we have established a high and low of the range for the week. That's when we can start to look at targeting 5 and 10 to 1 trade setup opportunities. Again, the object is to not be trading and not trying to figure out what the market's doing. It's waiting for them to show us their hand. I had a trader ask me, why did this trade fail? My question for that trader is, what does your best trade setup look like? And then ask yourself, if you don't have a best trade setup, you need to have a best trade setup, and then understand, did that trade that you took, was that one of your best trade setups? Because I don't know why your trade failed. But if it's not one of your best trade setups or one of your ideal trade setups, then it's just you trying to figure out what the market's doing and then get into the market to try and, get pips out of a move. So you want to be targeting opportunities when the market has established a trading range, and then we're working into the high for a sell high setup, working into the low for a buy low setup, or we're in a breakout pullback continuation trade opportunity for a measured move in a trend trade situation. So if we take a look at the euro, again, we'll talk about this in some coming videos. The initial trading range for the week, Monday broke Friday, the previous week's high, peak formation high. So again, we had other time frame traders triggered into the market. We then had the engulfment at the high of the day. The Europe-London window retested that before pulling back and hitting the low of Asia, creeping back up above double zeros, and then 25 pip stop hunt into the previous day's session. But Monday now gives us a high for the week and a low for the week. Then the question I want to ask myself is, the next day as we trade, are we working into the low, or have we pulled back inside and we're trading sideways, whatever that may be? They've gone down and hit the low, given us an extended W formation with an engulfment and a 25 pip stop hunt back up inside of the range. So when you see a creeping trend, 1 push, 2 pushes, 3 pushes down, understand that every time this market creeps down, it's accumulating buy stop orders on these lower highs. This becomes fuel for the move back up in the other direction. So a creeping trend that eventually jams into a previous day's low, or to a session low, or a 4-hour daily low, whatever that may be, and triggering other time frame traders. We trigger other time frame traders, they engulf the low, and then the move is fast and aggressive back up. So creeping trend into an extreme and a fast explosive move back in the other direction. A creeping trend into the peak, accumulating sell orders underneath, and then a stop hunt back down through the lows. So Monday, Tuesday formed our high low for the week, and then the market traded into the low. On the Wednesday, we had the Fed, and then the explosive move after the Fed. Then Thursday gave us a breakout of Wednesday's high, a false break reversal, peak formation, stop hunt. They go up to the 50 level, not quite 25 pips above the high of the week before pulling back in one push, two pushes, three pushes into the low and a 33 and going into sideways consolidation. So again, Monday, Tuesday, Wednesday, trading into the low of the week, an explosive move, hitting the highs of the week, a false breakout, pullback inside of Wednesday's high, the high of the week, sideways, and then the rollover underneath the peak formation on Friday, payrolls Friday, and a fast, aggressive stop hunt back down through the low of the week. So understanding as we went higher on Thursday, we had higher lows and we accumulated volume up above in that upper 25 pip box. And again, when the market was hitting stops and then went sideways in the peak formation underneath on Friday, we now had a market rolling over for the fast stop hunt back down. Other time frame traders are triggered. They broke the high of the week. They also broke the previous day's high. They pulled back inside of the range and went sideways, retested that inside on Friday, inside the previous peak, rolling over. We had higher lows, again, accumulating sell orders higher up into that 25 pip box before breaking down and going underneath an engulfment and the fast move back down. So creeping trends established buy and sell orders for the fast explosive moves in the opposite direction. So again, reinforcing, understanding other time frame traders getting triggered into the market. We have the high of the week accumulating above Wednesday's high on Thursday, peak formation. They stop hunt back into it, trade sideways at the peak before dropping down, then retesting that on Friday morning, the shortened M formation heading into the Europe London 12 candle window, the engulfment. And again, very similar to the year, we had higher lows on Tuesday, Wednesday, and then the fast explosive move back down to the low of the week. So other time frame traders getting triggered into the market, up high, down low, low of the day, high of the day, high of the week, low of the week. And again, heading into a new month, we'll have low of the months and high of the months possibly triggered on some of the major pairs. But when you have volume trapped up high, this potentially can become fuel. And understanding your time frames are the high probability time frames for these markets to move and hit stops, and also other time frame traders being trapped in the wrong direction, down low or up high. So hopefully you got some value from today's video, traders. Mark off your charts. Understand timing is when we want to execute. Other time frame traders is we want to know who is trapped in the market at those times in the wrong directions, down low or up high for the move, fast move, explosive move back in the other direction. So have a great trading session. Stay disciplined, stay focused, and may the markets go with you.
Hi traders, it's Stacey Burke from Stacey Burke Trading. If you haven't done so, please head over to my website at staceyburketrading.com. I create updates on almost a daily basis, and I would love for you to receive them. Just click on the blog. If you want to enter your name and your email address, I'll send you my free audio program, the 7-Step Daily Routine for High Performance Traders. This is essential knowledge for all traders in all markets, and this is for helping traders to master the market with discipline, confidence, and a winning mindset. I appreciate all your feedback and comments. As always, traders, stay disciplined, and may the markets go with you.